I think we're on, Shanti.
Okay, great. Good to be here, and welcome Rajan and Satveer to this session. I think we're going to talk about a little bit about angel investing. I think the art of angel investing, but I would say the conversation would also be around the science of angel investing. I think we're going to talk about both of those aspects. But just as we get started, let me kind of do a quick introduction. I know most of you know Rajan as well as Satveer, but just for the sake of the people who might be new to this space, Rajan is today the partner at Sequoia Surge and has been one of the most active angel investors in the Indian ecosystem. I think your angel investing journey starts almost a decade back, Rajan, and we would love to hear, what would be your thoughts around angel investing. But then before that, also a quick introduction to Satveer. I think I met Satveer in 2014, right, when you first came to India and started your angel investing journey, and started a formal approach to angel investing. So we'll also talk a little bit more about that. But just as we get started, I'll also make a quick introduction about myself. I'm the founder of Let's Venture. We are today India's largest marketplace where we work with founders and investors and we help them fundraise. So far, Let's Venture has done about 340 deals on the platform, raised about 200 million for the founders. We have about 7,000 investors from 55 countries, and still a lot more to do at the Let's Venture platform. So with that, let me get started with Rajan and ask you a quick question on when do you think people should start angel investing? What phase of their career, or how do you look at just the first steps of angel investing? How and when?
Yeah, firstly, thanks for having us, Shanti, and I hope everybody is safe. I'm in Delhi, which is obviously in massive crisis mode, much like several of our other cities are. But please, regardless of which part of India you're in or which part of the country, and I hope you're safe and take care of yourself. Look, I think angel investing. So I'm going to start with something maybe that is not as that some people may not want to hear, which is this is not something to do for wealth creation. Okay, wealth creation may happen, but there are easier and better ways to make money. Okay, uh, let's start with that because today everybody wants to be an angel investor. I think it's a dangerous sport. If you like triathlons, you should do triathlons. But if you don't like running, triathlons is a bad idea, right? So I think you should. I think the reason to really do angel investing, I would say first and foremost, is if you're intrigued by startups, or if you're passionate by startups, or if you're really curious about innovation and what's happening, or if you just like to spend time with sort of fearless, bold, entrepreneurs, young and old, who think they can change the world. And most of them, some of them may actually end up changing the world, but many of them won't, right? So I think if you really have one of those interests, then I think it's a very interesting thing to do. Now, if you get into it because of that, I think if you actually develop your own strategy, and I think there are many different strategies, and if you stay at it for 10 or 15 years, you could actually end up, creating real wealth, right? But that I think is a 10 to 15 year sort of journey, and you have to stay at it, right? So I would say, look, that is the reason to become an angel investor. I don't think you should become an angel investor because you think you can make a lot of money in the next 3-4 years. And we can get into sort of what you can, what the success ratios are from a portfolio standpoint and so on and so forth. But if you're excited about startups, if you're curious about innovation, if you have some level of disposable, and it is also, you have to have some level of disposable capital, right? To be able to sort of participate in the asset class, not because it's required, because it's prudent, right? And so I would say, that's sort of how I look at it, Shanti. I did not get into angel investing because I thought I was going to create wealth or value or any of that. I graduated from MIT. A lot of my friends were starting companies. Some of them needed capital. I had a job. They didn't have a job. That's sort of how it started a long time ago. It's more than 10 years ago. And then when I moved to India 15 years ago, 16 years ago, is when I thought I'd, start doing it more systematically, join the Indian Angel Network. And, since then I've been very active. So it's a long answer to your question, but that's sort of how I think about it.
Yeah, so basically just play money, high risk capital, right? You must do it. You should not do it if you want to use that money to send your kids to college, right?
That's a
So,
really bad idea. Yeah,
yes,
if this is the capital, don't. This is not your capital to send your kids to college or for you to retire on or whatever, right? It's yeah. I see a lot of sad faces, but yes, it's good.
yes, yes. Satveer, let's come to you. Tell us about your journey of angel investing. What brought you to this asset class? Because I know at that point of time when you came to India and you started up the Singapore Angel Network, right? You were one of the most active participants in the space. So talk to us about the thought process there.
Right. No, thank you. I think Rajan's also being very modest. He has created a lot of wealth, if you know his portfolio also. But I think it's important to remember that it isn't for that. And I agree. I think illiquidity also one point I wanted to add of the space. A lot of people don't understand when they get in exactly how long it can take to get the money out. I think for us, we looked at this primarily for three ways. The first was what our core businesses were lacking. We saw in some of these startups in the ecosystem around us. And so when we would look at the disruption that they were approaching industries that we were with, we were actually taken aback. And so initially, when I moved to India, as you remember, it was primarily for real estate. And over time, I got more and more intrigued by this asset class and now spend a fair amount of time in it. But I think for me, the first and most important is what it brings for you and also what you bring to it. So in our case specifically, initially we started looking at tech for old industry. It could be for manufacturing. It's very honored to have done an investment with Rajan called Nsinga that we understood because we were garment manufacturers and they were providing insight for manufacturers. And so that's the approach that we took. In spaces we understand disruption that could be. I think the second for us was about exposure to technology. I think as a traditional business family, we didn't have any exposure to the asset class. So it was very important to learn about it. And that was very important for me personally to understand, I think to Rajan's point earlier, what was happening and just to spend time because I really enjoyed it. I think the third reason for us, this asset class has been one that we've spent so much time in, is because we've seen the growth in the tech ecosystem. The India internet ecosystem 8 years ago when we started was much smaller than it is today. We still feel there's a long way to go, and that in the long run will change how all businesses and people function in India. So that was the rationale that we entered in, and we still hold by.
Absolutely, absolutely. So this is really a good kind of segue into probably the next set of questions. We'll try to deep dive a little bit more into how do you look at angel investing if you're a new investor. What should you be doing? I think there is a lot of conversations today around saying it's a high risk asset class. A lot of people say this is not for me, right? Because I don't have the appetite to probably take so much risk. But having said that, once we assume that we want to still enter this market, how do you actually go evaluating companies? So Rajan, if I were to come to you, I know like you are one of the most prolific investors, and like Satveer said, I think you're being modest. I think you have had a lot of very good success in your portfolio, right? So how do you go about evaluating your investments, or how do you decide that you want to invest into the founder?
Yeah, so I think firstly, there's because I think about half the group, the organizers has told us the audience that would come to the session. I think about half the group is thinking about angel investing. I think the others are active. Some of them have done, less than 10 investments. Some have done many more than that. So I think part of, how you look at investments also, I think, Shanti, depends on if you're just starting up. I think if you're starting up, it's really important that you're that you're co-investing with others, right? It's like anything else. Look, so let's assume for a minute that you said, look, you want to do this either for one of the reasons that we just talked about, not for wealth creation, right? And then you set aside some pool of capital that you're willing to sort of go do this with. Then I think it's really, really important to spend a few years learning how to do it well, because this is really an apprenticeship business, right? This is not a business where you can read 3 books and then become a really good angel investor. Or watch this session, or watch a lot of YouTube videos. So I think co-investing with others, right? Like Let's Venture is a great platform. There are other platforms like that. Joining an Indian Angel Network or a Mumbai Angels. I think taking the time to co-invest with other seasoned investors, so you can really learn how to do it well, I think is very important for new angel investors, right? I get really worried when I see new angel investors trying to lead an investment. Please
Yeah.
don't do that. It's going to be bad for you, and it's really going to be bad for the founders, right? Sort of co-invest with others. If somebody's really sad with the things that I'm saying, I'm so sorry. I don't know what I'm saying that's making you sad, but just be happy. Look, this is what it is, right? It's always good to learn what it is, sort of upfront. I think if you're, but once you've done that, I think what is, at least in my mind, the way I think about it is come up with a strategy. Look, I had a, I had a. By the way, I mean, I was very very active until I joined Sequoia. Now I'm at Sequoia, right? So all my, I only invest through the Sequoia funds, and at seed stage, we have Surge, and develop a strategy, right? So, and I think there are many different strategies. So Satveer can talk about his strategy, which is very different to my strategy. The strategy that I had was I wanted a portfolio of companies. Right. So I would say starting about 2010, I was doing 10 to 15 investments in India per year. And then I had a bunch of other companies I was investing in places outside of India, especially the US. I would only invest in things I deeply understood, which is tech and tech-enabled companies. I did not invest in anything outside of things that I understood, because I figured, I couldn't really add any value if I didn't understand the business. Not let alone I couldn't decide what to invest in if I didn't understand it. So I was very clear on that. And third, I had a model where I said I was always on call. Right, founders could call me whenever they needed me. It didn't matter what time of day, what day it was, etc. But I didn't. I was running. I was leading Google's business in the regions, so India, Southeast Asia. I didn't have time to follow up with entrepreneurs and say, how's it going, right? So I was always on call. So that was sort of my model, right? It was a portfolio. It was tech and tech enabled things that I deeply understood. And I was on call. That was my model, right? So I would say, have a strategy. Now, Satveer has a very different strategy that we'll talk about. There are many different strategies, right? But having a strategy is really important. Once you decide, I would say, so the way I think about it is, if you're just starting up, the first 2 or 3 years, co-invest with lots of others, so that you can learn, right? And after that, and as you're doing that, you'll get a sense of what are the kinds of businesses that you like, what do you not like, what is your model going to be? Are you going to focus on fewer number of companies, be very very hands-on, go very deep, go very proactive, or are you going to be something else, right? Like, so for instance, Vishal Gondal, who's a dear friend, Vishal, when he was active angel investing, Vishal had a very different strategy to me. Vishal also did tech, but he focused on fewer companies. He went very very deep. And by the way, different models can work, right? But having a strategy, I think is really really important, because you don't want to. And also, look, so in the first few years, you want to co-invest, so you should follow, right? I mean, you should follow, you should learn, you should observe, but after that, if you've done more than 10 investments and you're not making independent decisions, meaning you have a point of view on a company, then I would worry about that, right? Because you need to be decided. Like, I never ever decided to invest as an angel because somebody else was investing. It didn't matter to me whether it was a venture capital firm or some other investor. I didn't care, right? I made a decision on what to invest by myself, because and again, right, I could only do that because I was investing in things that I deeply understood.
So I think for me, I think the very interesting point which is coming up, which we also recommend to our investors, is at least attend 15 to 20 pitch calls before you actually go invest into a founder. Because the first founder you meet, you could also get overwhelmed by just the grandioseness of the vision, right? And sometimes founders have this very unique ability to make the investor feel like God, right? But you're still not God, right? So you have to kind of look at about 15 to 20 founders, listen to them, and then actually go with what really resonates with you, right? So really kind of agree to that point. And I think one very important element which has come out when Rajan was talking is about what is the value I can bring to the founder. I think that is a very very good way to look at when you're investing, and not say what can the founder create here, right? But how can I come and create value to the business I am investing in, because you become a shareholder in that business, right? And really earn a seat on the cap table. I think today investors have to kind of think that, because in today's world, at least 2021, in this decade, capital is more than available, right? I think now investors have to really earn their right to be part of the founder's journey, is what I have learned in the last 6 years. But Satveer, would love to hear about your strategy and how do you think about creating that thesis around investing?
Yeah, I think so. Our strategy is focused more around the fundamental unit economics of businesses that we look at. So I think, as Rajan alluded, we've maintained different strategies on certain investments, and thankfully I've had the chance to co-invest with them on a few. But I think for us, it's when we look at a business, it's always very important to understand their path to revenue, their path to money making. And so what that actually entails is when you look at exit outcomes, many times we may be looking for businesses that are meant to be built to, let's say, a $200 or $300 million. They're not meant to be built out to $10 billion companies. And I think it's very important to understand how you look at it. And so if you were to ask us, I think we would say we'd rather have 10 exits at $300 million each than to have one $10 billion exit. And that's an entry and exit strategy that we've maintained. I think the other piece, and this is over time something I built out, and to your point about the value you bring, we are always focused in saying, what is it that we understand? And more often than not, that has come to the industries we're in, the sectors we play in, or the enterprises we work around. And so sometimes we back work sectors saying, okay, this is where we have a deep amount of connects. And this is the kind of startups that we think would fit it, and we'd go out and find them. This could be cross-border between India and Southeast Asia, could be domestic for either of those markets, primarily India. But I think the core would always remain, what is the differentiator that you're bringing, and how is it that we look and understand to work with it? I think over time, as Rajan mentioned, I think the first 10 deals, 15 deals, even if you're not clear where you want to and how you want to do it, that's okay. But very important to deliver your own theses. And going back to the initial point, the space is not one that you should come in saying, I will definitely make a lot of money. I think this space is to come in and say, this is something I want to cut my teeth into. Money will come, hopefully, but it's very important to understand why you're doing it. And I think for us, what's been very clear from the first day, we've also looked at this as some form of capital protection. Now, we're not saying protection versus stock market or the other investment asset classes, but when we go out and make investments, we always still look at downside and say, okay, what are the chances this goes completely bust? What would that be? So I remember a very good anecdote I'd like to bring up with Rajan. I don't know if he remembers this, but about 4 or 5 years ago, I looked at the company in a media space, and I called Rajan and I said, Rajan, we should look at this deal together. And he said, look, Satveer, this is going to be a clear 4 or 5x in 4 years. It's like, that's not my style. That's not what I'm looking for. I need more. And that's exactly what happened. 4 years later, we got a 5x exit. Call Rajan. He's like, glad you did it. But he's like, and so it's very important to know where you fit. And he was spot on with what the exit was. And so I think, that's what I want to say. I think it's your strategy, how much capital you want to put at risk, how that plays out, and how you look at what you're doing it for. But very important to develop your own personal strategy based on the strengths you have. And very honestly, people have gone into angel investing and developed strengths they didn't have, which I have seen in the ecosystem. I think the other piece I'd want to say is that Rajan and I come from 2 very different backgrounds. Rajan has been leader in the tech industry for a long time. I came from a very traditional background. And I'm sure there are people on the call who come from backgrounds like us who are looking at this saying, how do you learn about technology? And investing, putting your money in is a great way. But then you also need to know that you don't know a lot. So try not to give advice, step back, watch, let people that do know lead, and you follow in the early days until you develop your niche.
No, absolutely. So I think the next point which I'm going to come to, which is a little bit interesting and I think a little more controversial, right, which I would love Rajan to address, is great teams versus great markets. I think there's been a lot of debate. A lot of people have a lot of different views in how do you actually look at a great team versus a great market, and the role that particular aspect plays into the investment decisions for investors. So would love to hear the angel perspective and the VC perspective here, Rajan, because you come from both sides today. And I think that...
I think it's a great question. Look, so I think as an angel investor, at least my approach has always been over-index on the team, right? I'll give you an interesting example. When I invested in Innovasa, which just became a unicorn, their co-founders were really, really smart. They were doing some machine learning services projects for MIT and Harvard profs or something like that, right? I mean, that's not a market. I mean, what is a market? But there's no market there, right? I mean, so that was basically a team bet, right? So when a few of us did the first angel investment in 2009 in Druva, they were doing like data backup for, they were doing notebook data backup for notebooks because they'd figured out some way to do dedupe data at source. I mean, like, you know what I mean? I mean, it was like, but we thought Jaspreet and his co-founder Milind were like really, really awesome, right? So I do think, keep in mind when you're investing at angel stage, companies pivot a lot. Lots of things change, right? And you've got to over-index on very, very strong founders, because this is one. I mean, they're really, as an angel investor, there shouldn't really, you should never. At least my view is, I don't care how big the market is. If you really can't build conviction around the team, I wouldn't do it. At the same time, if you have a lot of conviction around the team, I would focus maybe a lot less on the market. But the broad space you should, because the broad space really is, this comes back to, do you understand the space, right? It's a great example that Satveer said, like online media. Now things are changing, by the way. Also, timing is different, right? Daily Hunt is now, a unicorn built on advertising, but that took a long time to sort of get there. So I would say over index on the founder, but make sure that the space is large enough and where you can build a reasonable company, right? So that's at least that. Look, every time I backed as an angel, when I invested, when I got carried away with my own thinking, right, on the market, saying, wow, this is a really exciting market, I think, look, it doesn't matter what you think. What matters is, are the founders capable of building that company, right? Because
Yes.
you're an angel investor, you may own 1%, maybe you'll own 4%, whatever, but or maybe you'll own 0.1%, but it's the angel investors who are going to build that. And I think that's really, really important. Look, as a VC at seed stage, so at Surge, which is where I spend my time, right? We focus on both, but again, we come back to the founding team, right? Do we really, really believe that the founding team is super awesome? But as a VC, we also focus on the market, right? See, as an angel investor, Shanti, I was comfortable if I could get 100, if the company could get to 100 or 200 million, although that was not what I preferred. Satveer and I have had lots of chat where I'd say, look, this can be $100 million company. I'm not interested. But if I really like the founders and I said, okay, this can be $100 million company, that was okay, because this was also, remember, 4 or 5 years ago, where you could do a seed investment at 5 crores or 10 crores or whatever. Now things have changed. But as a VC, that's not adequate, right? So you've got to see, or you've got to be able to imagine a $1 billion company being built valuation. Otherwise, just the math doesn't work. So I would say, as a VC, again, we over-index on founder quality, but the market becomes a lot more important. And I think as angels, I mean, there are so many things I would have done differently as an angel. Now that I know, I've been at Sequoia 18 months, Shanti. I just wish I'd done this a long time ago, because I would have just been a better angel investor. But one thing I've learned is to spend more time on the market and really making sure that, can the market be large enough? Right? Because then you increase the odds that the company will go on to raise Series A and B and so on and so forth.
But in terms of priority, right? When you look at an
over-index on the founding quality, over-index
right?
on the founding quality. I tell you, I mean, it's not even a question, because
Yes.
lots of things will change. Founders will pivot, especially if you're going in truly angel, right? I mean, the best angels, when we invested in Druva, I mean, there was like some product and maybe 2 customers or something, and there was no revenue, right? So Innovation, I mean, he had a bunch of professors who were customers, right? So and I can go through lots of other examples, but I mean, these were not. I mean, you have not much to go with, right? As an angel investor, I mean, what are you betting on? You're betting on the team.
Yeah. So what would be that 1 or 2 things, Rajan, since you just alluded to it, right, which you would have done differently had you actually had the insight of the VC world, right, which you have today? What would those 1 or 2 things be? We would love to hear that. Even I would love to hear that.
I think one is on the space, right? I mean, giving more thought to the space to sort of figure out, is this a space where you could build a multi-billion-dollar company? That's one, right? I probably invested in a bunch of founders who were really passionate and who I just generally liked, but they were not in markets that could, lead to a multi-billion-dollar company, right? I think that's one. Second is, look, sometimes I would worry a little bit about valuation, but I didn't obsess about it. But I should have not cared about valuation at all. And again, this is where I think Satveer and I maybe we'll think about it differently. Because keep in mind, I'm going for the I always have, right? Even as an angel, I was trying to look. I was much more interested in, is a company going to get to 1 or 5 or $10 billion? Because that's when I was going to make 100x or 1,000x, right? I mean, I just wasn't interested in 5x. Because that's sort of not. I don't know whether you know this, but Ram Shri Ram, right, put $500,000 in, made 4 billion on Google. I mean, we are going to start seeing Googles, right? I mean, the question is around why angel investing, why now? Because in the next decade, you will see many, many very large companies getting built.
Yes.
Indian startups getting built, right? So you can make 100x, 1,000x, or 5,000x, right? And that's what you want to look for. If that's what you're gunning for, Shanti, it doesn't matter whether companies valued at 2 million, 5 million, 10 million, or 15 million. The only question is, can it be, can it become? Does it have the possibility to become several billion dollars? So, like for instance, when I invested in Innovation, I think they wanted 10 million, and I thought it was really high at the time. And I was like, wow. I mean, but now, the thing's worth 1.3 billion at last round. Innovation is going to be a $10 billion company. I'll still make a couple of 100x, right? And
Yes.
so I think that's the second thing, that I think this is a mistake angel investors make. They obsess about valuation way too much, right? I mean, please don't obsess about valuation. Obsess about the quality of the team, and obsess about, is this a space where this can become a very large company? Because I got to tell you, it doesn't matter whether you got in at 2 million or 10 million, right? Because at 50 million, yes, you would have made on a multiple basis, but it's not like it's not a big change. And I think the third one is, I wish I'd known the importance of having the right investors at Series A and B.
Yes.
Right. I mean, who's on your cap table matters a lot, right? Because that matters, because it determines whether this company can go on to raise, Series B and Series C and Series D. So, a bunch of my angel investment companies, partly because I didn't know, and my founders always were trying to optimize on valuation and things like that. We passed on getting some of the tier one investors on our cap table, right? And that really cost us. It cost us. So I'd say those are probably the three things that I've learned.
Okay, that's actually very, very interesting insight. Because as a founder, my learning has been that whether you raise money or not, I think you should go fundraising as a founder. Because just like what you said, Rajan, I think sometimes angel investors bring you the perspective of market size, which sometimes you may completely miss as a founder, right? Sometimes you may not be able to. You don't know what you don't know today, right? And just going out and talking to a lot of people while you're fundraising really brings a very new perspective to the way you look at your business as a founder. But Satveer, coming back to you in terms of the mechanics of angel investing, right? Since you kind of have been, again, a very active investor,
Right.
tell us, how much time do you spend in sourcing, working with founders, building a network? There is a lot of smaller activities which goes into this
Right.
very small work called angel investing.
Right. So I think we spend at this point most of our time with our founders. And I
Okay.
think that helps with the other elements that could make you a better angel investor, which could be sourcing, it could be branding, it could be evaluation of the startup you're looking at. But I think it's also very subjective to where you are in your life cycle. If you're starting very early, I think it's very important first to get into the ecosystem. I think, Shanti, you mentioned this, get on founder calls, go meet people, understand what's happening. And as you start, I think another big thing on hindsight that I actually have learned is very early, I would have spent more time with startups that I'm not invested in, trying to help those founders. Because I think there is great value, even if you're not an investor, in spending time with startups. And what that does is it allows you to learn how you can then help the startups that you're invested in. I think that was a big learning for me going back, that I would have even worked on all the startups that I saw, opening doors, helping them grow. But for me, I think where we are today, it's definitely spending time with the founders. I think prospectively, that helps every other element that would then make you a better investor. Apart from that, I think it's very important to ensure where you are in the deal flow cycle. I think there's also many angels that I know that have lost all their money doing this. Reason that was is because maybe to the grandiosity of the point you raised first, or maybe just because what they were looking at looked incredible, but in truth didn't have the substance to be. So I think it's very important to know that you're investing in the right circles and the right founders. And for that, I think it's a matter of experience, and also then being the right informal and formal networks. For example, I think Let's Ventures put together an incredible way for you to back leading angels as part of their syndicates. I think that's the best way to start off, because you're getting the insight without doing necessarily all of the work.
Yes, yes. Yes, now, but I'll come back to your point, Satveer, on what you said. A lot of angels have lost all their money, right?
Yeah.
So let's talk about exits, right? I know Rajan started it saying don't invest with the intent to make money, but I
Yeah.
think at the end of the day, making money is just an indication of the business you have backed, right? Because if the business you backed, if the founders you have backed is the right decision, the outcome is that wealth is created, right?
Yeah.
So that's not, maybe may not be the direct intent, but I think it is an indirect very good
Yes.
outcome getting created, which also then helps new businesses to get funded, right? Because there has to be circulation of money which happens in the system. So
Yes.
talk to us about, as an investor, right? And we'll come to the Singapore India aspect a little later, Satveer, because I also want to talk about that, and what are
Yes.
the differences you see in the Southeast Asian market versus the India market. But
Yes.
talk to us about exits, and how do you look at exits as an investor who's just looking at, you said like a 5x, 10x return is actually okay for you.
Right.
How do
So
you define
I
exits?
think to clarify that where we believe we can make more multiples than that, we will stay on always for the journey. I think
Okay.
and I speak wearing singularly just as an angel investor. I think there are three types of ways you get exits. The first is, of course, whether you talk about trade sale, being bought up by another startup, or exit through, let's say, a larger corporate, whatever that would be. I think at that point, I'm okay taking a 5, 10x exit if I feel the the startup has reached its ability to, in that space, execute any further or take on, quote unquote, the bigger players. So in that case, we're very happy to exit along with the cap table, let the startup be housed in a bigger, whether that's a media company, whether that's, whatever that would be for that exit. I think the second piece, and this one on hindsight, I would have done differently, is when angels get bought out across the journey as secondaries. And when bigger VCs come in and say, hey, we want to clear up the cap table. Looking back at some of the exits we took, we may have made mistakes and instead should have stayed on with how big some of those companies have become. I think that is one of the learnings I've had, that when you have blue chip VCs come in, when you have much larger institutions come in, sometimes it's better to ride the journey. Earlier, my thought process was, oh, we're very small parts of the cap table. It may not, no, maybe nobody's looking out of your interests for your interests if things don't go a certain way. But I think now, looking back at the outcome of a few of those companies, if you feel there's long ways for the company to go, don't sell, don't necessarily get out. I think the third way is when you look at what we look at, is when you want to exit a startup and may not be an option. That's the one I think that takes where you and the startup may want to go different ways. That, as an angel, I think it's something that over time you have to build. But for me, singularly as an angel, I think whether it's being able to double down to have then therefore greater exits, or being able to stay the journey, I think as an angel, the biggest learning I have is to be there for the founder as much as possible on a compassionate relationship. I think that's really what people forget. There's the reason it's called angel. It's not meant to be as it's not meant to be money that says result oriented as institutional capital. And I think that is actually the biggest learning I've had as an angel. When I see rounds that we get super proratas and, or we now put significantly more than we did first, a lot of times what the founders say is that you were just there for us through the journey, through our ups and downs, and just someone to bounce ideas across. And I think that's key. And so back to the point on just exits, I think all of these help you get better exits. But I do want to say that if you look at, for example, the exits we have, exits are unpredictable very often. Great startups get offered exit, whether you want to take it or not. But the other key, and I think Rajan's point, what Google's being created is exits over the next decade, I see will be much larger, much stronger, and much more exciting. So I think this is the decade.
Yeah, so I want to go back to your second point, right, where you said that you get bought out by VCs
Yeah.
or you want to exercise your pro rata. I
Yes.
would love to take that question to Rajan, because in my experience of Let's Venture in the last 6 months, right, we've had some very good up rounds happening on our portfolio, and I think what we are seeing is that the incoming investors are not really willing to allow the angel investors to exercise their pro rata, right? And that is becoming a point of conflict, I would say, between the new investor and the existing investor. How do you address that, Rajan? Just from a perspective, because today the startup has got 2x, 3x oversubscribed. Existing investors want to double down. There is more capital
Yeah,
than.
I think angel investors shouldn't obsess about pro rata and all of that. Okay,
Okay.
so I think the only thing that matters is, can you get into the right companies?
Yes, I
Right,
agree.
that is the only thing that matters. Look, see, as an angel investor, you're not like, for you to have like, let's say a group of angels have whatever 10%, and to expect that you're going to have prorata, and some angels expect super prorata. Really?
Yeah.
Look, just so you know, I mean, I didn't expect any of this. Okay. And very rarely did I even do a prorata, because I had a different strategy. My strategy was, do a portfolio of companies, kind of every year, right? So I think, look, angel investors shouldn't obsess about the wrong things. You obsess about entry point valuation. You obsess about prorata. I see something on liquidation preference. Look, the reality is you own such a tiny percentage of the company. Okay. Firstly,
Yes.
the only thing that matters is become a giant company or not.
Yes.
Right?
Yes.
Number one.
Absolutely.
Number two, if it becomes a giant company, then it doesn't matter. Somebody's
Yes.
either going to buy it or it's going to go public and you make a lot of money. Okay.
Yes.
If it doesn't work, you're going to lose all your money anyway.
Correct.
So, as an angel investor, the things that institutional investors care about, I must tell you, sometimes I see these angel, companies that have raised angel round that come into search, and like their SHAs are 10 times more complicated than what we would do.
Yes.
And somebody invested $200,000. We are investing several $1 million. I mean, how can that be, right? That's not good, great for founders. That's not great for anyone. So, and I'd say last thing I'd say with what Satveer said on exits is, I learned this. I think it must have been late 2007 or 8. I was in a session with Kanwal Reiki. I was part of India. I was in an IAN session. Kanwal said something that I've sort of stick to, right? Which is, at every round as an angel, I would ask this question of, do I see a 5x from here or not? Right? If there's a 5x from here, then I generally stayed. If I could, and sometimes, VCs would want to buy out all the angels, and I was fine. By the way, one thing I always did, Satveer said this is so important. Keep in mind that this is the founder's life. It's just
Yes.
one investment for you. So be there for the founders through ups and downs, because that is what builds your reputation. Okay.
Absolutely.
As if you've invested in 15 companies and you don't have a reputation, by the way, you do. If you've invested in 15 companies, founders think one way or the other, right?
Yes.
They either think you're awesome, or they think you're terrible, or they don't have a point of view. Not having a point of view is better than thinking you're terrible. And
Yes.
ideal would be they think you're awesome, because if you're awesome, you will get pulled into other investments, right?
Yes.
So make sure that you're that you're always there for founders, right? So for instance, what that means is, like, let's say the founder really needs to free up space for an investment. Okay,
Yes.
maybe you should sell half your stake. I've done that many times, right? But the other half that I kept, has worked out really, really well, because that founder did well. And then because that founder thought very highly of me, I managed to invest in many other companies and so on and so forth. So
Yes.
at least for me, I use this 5x rule. In fact, even today, now I don't, I have large number of companies that I invested in, right? Many of which are keep raising these rounds. And I have a company right now, they're raising around a 200 million post. So the only question I've asked to exit or not is, can this do a 5x from here? So in this case, I said, yeah, this can be a unicorn, so I'm going to stay, because I'm better off. But keep in mind, by the way, once a company crosses $100 million, exits are not easy, right? Because the founder and the new investor would rather put primary than buy secondary. And if they're going to buy secondary, by the way, they'd much rather buy a bigger investor than an angel investor, because they want a big chunk, right? They don't want to buy like 0.2% or 50 basis points. They'd rather clear up 5%, so that they can buy that. So 5x rule I've always found interesting. And as an angel investor, really you only have two options, right? You can sell to a series A, B, C, D investor, or you wait till it goes public, right? So and every round you have, if it's a really good company, at every round you have the option to sell. And I do think that is something that honing, and even today, right, I can't get it right, because but now I've sort of said, look, can this company, and I've said, forget the 5x rule, can this company actually get to IPO or not?
Yeah. So I think for people who are listening to this panel, I think a very, very key takeaway is the role and how you think about yourself as an angel investor. I think this is almost like a pay forward, right? So you have to work with good founders. You have to give first before you can get. And my belief is, as we are seeing the ecosystem evolving, I think it's increasingly hard to get into good company cap tables. And I think investors underestimate the network which founders have today, right? So if there is a bad investor, 80% of founders know about him and they do not want him on the cap table, right?
Yeah,
So
and Shanti, just to build on that, right? Look, if you
yes,
yell and scream and you lose your
yes,
temper as a founder, you will
yes,
not get into any company.
yes,
It's
yes,
super important because what angels don't realize is, look, there's a reason the founders aren't doing well. Okay,
yes.
so be there for them, mentor them, give them advice, but don't lose your cool. And by the way, if you don't like losing money, meaning if you don't like companies sort of shutting down, this is a really bad thing to be an angel investor.
Yes,
You know,
yes,
I see angel investors losing sleep because some company shut down. I'm like, oh God, you should be glad it shut down. Just ask for a write-off and move on. You know,
yes,
because remember, like a lot of companies shut down in your portfolio, right?
yes,
So when a founder calls me saying, look, it hasn't worked out, Rajan, I'm shutting down, I only do two things. I only have two questions always, right? Firstly, I'm glad because I can take it off the, sheet. And I ask two questions. One, what can I do to help? Second, if you really don't mind, I'd like to take a write-off, buy my shares back for a rupee.
yes,
Because India, otherwise it takes like 3 years to shut down a company or something, right? And then
yes,
by the time I've forgotten about this company, so I'd rather
yes,
take a tax write-off and then be helpful. And I will go out of my way to help a founder that has not succeeded in the current venture. Either land a job somewhere, or if they want to start up again, help them think through, what they want to start up. These are the things that build your brand. Right?
yes,
As an angel investor, I'm telling you, if you've been angel investing for 3 or 4 years, you don't have a brand, you're not getting into interesting companies. Guaranteed. Doesn't
yes,
matter who you are. Right.
yes,
So this notion of building, there's something called founder NPS, right? Net promoter scores. How many of the founders that you've invested in as an angel are promoters of you as an angel?
yeah,
Right. And a lot of angels just don't think about this stuff. Right. So they're not nice to their founders. They get upset when they lose money. They think they can run the companies better than the founders. Oh gosh, I mean, you should not be an angel investor. Just keep running your own company.
yes, absolutely. So now I think with that we'll go to audience questions. I think Rajan has actually spoken a lot about what I would have loved to tell the angel investors, right? Because I think people do not understand that founders are putting the next 5 to 10 years of their life 24/7 into building that company. And sometimes mistakes happen, right? So I think it is important to have that compassion. But just adding to that point, Rajan, I think one thing what I've started seeing in angel investors is in the hurry to invest into a company, and a lot of platforms are doing this, there is no due diligence done on the business. At least a minimal due diligence should be done before you do call for money. I think it's better to do that diligence before you put the money than to start hammering the founder after you put the money, right? So I think as an angel investor, it's also important to be responsible about where you're investing in, ask for those documents, ensure that there is no, compliances, governance issues. And then that would actually start to create a better journey for both the founder and the investor.
Right.
But with this, I can see Gaurav come online. So I think Gaurav, if you have the audience questions, I think I can see a lot of questions coming up, but handing it off to you.
Absolutely. And sorry to break the flow. It's been an amazing panel learning from the veterans in that sense, right? We'll just take two questions because we're running slightly late for the next panel. First question that we have from Amit: what is the deal size you'd recommend for first-time angel investors, right? Say for their first 5 deals, what's like a typical amount that you would recommend to them? Satveer, you want to
Yeah,
take that up?
Shanti, you want to take that? You see, you have the latest data.
Yeah. So then typically we recommend, SEBI has put this regulation, but it is 25 lakhs over 5 years, right? Where you kind of allocate 5 lakhs per year. But we have rarely seen people follow that model. I think once you start investing and you start meeting founders, and if you have the capital, I think you should do more. Because sometimes, writing a very small check also does not give you that return which you want to look at in the long term, right? So there is no formula, but typically start with about maybe 20 lakhs a year at least, right? I think that's a good number to kind of keep aside. So you can make about maybe like 4 to 5 investments in a year.
Right. Thanks, Shanti. And one last question. Rajan, you've mentioned that you over-index on the team, right? And a question to all three panelists. What are those one or two qualities that you really look for in a founder while investing?
Yeah, I think there was also a question on founder market fit, right? So what is founder market fit is what is the reason that these sort of this founding team, single founder or founding team, is going to be able to win in this market, right? Do they have expertise in that market. Ideally, they would have faced the problem themselves, or they come from that space. So this morning we made a very interesting SaaS company, right? I mean, who's solving a very specific problem in SaaS. This founder has lived this problem for the last 4 or 5 years and said, look, I'm going to now go and solve this, right? So obviously, so just making sure that the founders they have expertise in the problem area that you're solving, right? What's a great example of not having founder market fit is everybody thinks edtech is really, really hot. So everybody wants to be an edtech founder. Well, that's a really bad idea, because what do you know about edtech? I mean, edtech being hot is not a great reason for a founder to be starting up in edtech, right? So I think that is that's super critical. And the other thing you're looking at is also, are there things in their history, right, that show that they've got perseverance and determination, right? Can they stick with it? Because the reality is, look, it takes 10, 15 years to build a company. You're going to go through 5 near-death moments, right? Is there what I mean? Like, do they come from, one of our founders in Surge, right? They grew up in a village. The guy, him and his brother used to walk like 2 hours to go to school every day, right? From the time they were 4 years old. I mean, and now this is like their 3rd company, and the first 2 companies failed. God, I love that. Because they're going to keep building for the next 30 years, and it's not going to matter what happens, so that shows perseverance, right? So I think those are the kinds of things that at least, I've always looked for.
Satveer?
Oh, yeah, sorry. So I think definitely echo the importance of the founders knowing the sector and the problem they're solving intimately. It allows them to be fluid about the solution they're building also, which consistently then ensures that they're up to date, have the right networks in that ecosystem to be aware of changes. I think apart from that, and I guess how you test this is it varies, but it's also, apart from, and perseverance, of course, critical, it's also the teams that you predict the founders are going to build. I think across the data that we've seen, one of the greatest predictors of success was after the first round, let's say after the first round angel investments, who did the founders bring on? Because you can't necessarily know this before, but thinking through who they're bringing on and how are they building something that goes from then, maybe $5 million to 100 is very important. And we always try to understand the thought process of the team, of the founders with the team they want to build.
Yeah. So for me, it is more clarity of thought, right? It is just, when you're talking to the founder, why are they building this, right? Do they understand the nuances of that deeper? Just like what Rajan said, right? EdTech being hot is not a reason why you should start an EdTech company, right? Do you understand the problem you're trying to solve in a very, very deep way, right? So you can't ask a question to a founder and then he says, oh, let me think about it. It always alarms me, right? I love founders who actually say, yes, I know what you're saying, I agree to it, but I would disagree and this is how I would do it, right? Because I think if you're spending 24/7 living your idea, building your company, you should know everything about that space really well. And you should have a very clear point of view on why what you're trying to do will be a successful way of solving that problem. Yes.
Some amazing pointers there. Thank you so much, Rajan, Satveer, and Shanti. You guys have been phenomenal. We'd request our audience to move on to the next session, and I'll just close this session with your permission.
Thank you. Thanks,
Hey,
Rajan.
thank you.
It was
Thanks, guys.
fun.
Bye-bye.